I think they will have a hard time going back to QE as a monetary policy tool. That's my own. I mean, I think they might try in the next deep recession if rates get close to zero. They might have to, but QE has been kind of has lost its favor even among the people who were its most ardent proponents back when it was first launched. And so I think the view about how much QE can do to stimulate the economy, like the general consensus view now is that QE works as a kind of emergency tool when markets are breaking, but not as a stimulus tool, just as a substitute for zero, for rate hikes when rates are at zero. And so even I think that tool is kind of, potentially not as strongly in the toolkit as before. So to your point, the Fed will be more powerless in the next downturn to be able to stimulate things.
Welcome to Wealthion. I'm Wealthion founder Adam Taggart. We've frequently commented on this program that it's hard to be an investor over recent years because central planning policy has been by far the biggest driver of price action. Instead, we're forced to be speculators, placing our bets based on what we think those few policymakers will decide to do next. Now, last week's near-death moment for British pension funds is a classic example of how a change in policy can disrupt everything in a heartbeat. So we should try to get the best bead we can on where policy is most likely headed. To this end, Wealthion has recently spoken to former Fed senior economist Lacy Hunt and former Fed advisor Danielle DiMartino Booth. But today we have the good fortune of adding respected journalist Pedro de Costa to that list. Pedro spent the past 20 years covering central bank policies for publications such as Reuters, the Wall Street Journal, and now MNI Market News. Pedro, thanks so much for joining us today.
My pleasure. Thank you so much for having me.
No, it's wonderful. And it's great to have you here for the first time on the program. I hope it's the first of many repeat visits. I like to start these interviews just at a really high level, Pedro, and feel free to answer this any way you like. But what's your current assessment of the global economy and the financial markets?
I think we're at a kind of dangerous and pivotal moment, to be honest. There are already a lot of macro risks that had been building, given the rapidity of the tightening of Fed policy and not just the Fed, but policy from central banks around the world is being tightened at kind of record speeds. And there were a lot of tensions already about, you know, the macro risks and the potential for unemployment to rise, the potential for emerging markets to have food crises or debt crises. But now we're talking about financial instability, as you referenced in the intro, right at the heart of the global financial system, right in the UK, in a major developed economy, and so I think we're seeing the first inklings of some troublesome times ahead.
Okay. And we hear a lot that the central banks are going to tighten until something breaks. We might be seeing some of those first fracture lines here. That said, let me toss another general question up to you here, which is, what's your current assessment of Fed policy right now? Is it the right policy for the times we're in, or do you think we should be doing something, the Fed should be doing something different than it's doing right now?
Well, to be honest, in my current role, telling the Fed, telling the world whether the Fed is right or wrong is not really my position. What I can tell you is sort of where I think they are in the cycle, right? They reacted too slowly by their own admission to the inflation that started to take over at the end of 2021. And I think in playing catch up, they've had to reestablish their credibility by saying we're going to tighten no matter what. To your point, we're going to tighten until something breaks, and we don't even know, kind of what category of something that has to be, because a few things, as you mentioned, have already broken. And so I think the Fed is very resolute at the moment to keep going, even in the face of economic weakness, even in the face of potential rises in unemployment and worsening in economic conditions here, even in the face of a fairly deep recession potentially. But it is a big question mark as to what kind of financial disruptions it might take for them to maybe not even pause on the tightening side, but maybe take some emergency actions in other areas to stem kind of liquidity crises that might pop up from the kinds of things that we're seeing.
Okay, and I actually want to dig into that just a little bit in a moment and what those other tools, those other options might be. Um, but Okay, but so the Fed, one can say, central bank policy contributed, maybe in a big way. We can argue on the magnitude, but contributed to the inflation that we're dealing with right now. By its own admission, it was slow to respond to that. Now it's trying to make up for lost time. Um, the Fed is risking, as you're saying, the more aggressive it is, the more it risks some sort of systemic instability. And the Fed is telling us right now, at least, hey, we're playing for the soft landing. We're gonna thread this needle, and we're gonna bring inflation under control without sending the system into a massive tailspin. That's what the Fed is saying. We look at the Fed's past record of predictions, and honestly, it's not great. So my question for you is, what's your level of confidence here that the Fed, Powell and his team, can get it right here, that they can finesse the type of outcome that they're looking for here? How much confidence do you personally have that they're going to be able to do this without, either pivoting before inflation gets under control or really breaking something bad?
Well, what's interesting is when you say that they're still angling for a soft landing, I think that if you watch their communication shift carefully enough, have already admitted that a soft landing is quite unlikely. They, in the last summary of economic projections, they revised down their economic forecast for GDP down to
Zero,
well,
basically.
yeah, zero basically, which is as close to, I think DiMartino Booth is the one who told me that. It's as close to admitting a recession as the Fed is ever going to get. And so they've already kind of taken the soft landing off the table on the macro side, but they haven't quite given us any parameters with which to judge how they're going to react to potential, financial debacles, if you want to call them that. And so that's the next thing that I think markets are going to be watching for now that the conversation has shifted away from the macro side and more toward the, where the loss is hiding stage of the game.
Right. Okay. And I think it's important that who cover the Fed and has covered the Fed for so long, thinks that hey, you know, they're saying, look, soft landing probably not going to happen right now. Of course, they're trying to avoid the full-blown plane crash here, right? So the question really becomes how much can they finesse? I mean, and to your point, Powell used the word pain. He basically said households and businesses are going to have to prepare for pain. And to me, that's the closest you'll ever hear the Fed saying, like, I'm deliberately creating a recession to bring inflation under control. So he's trying to get us to kind of gird ourselves here. Of course, there's a lot of people that are skeptical of the Fed's ability to really do whatever it takes, only because they think the system is so fragile at this point that something really serious is going to happen, sort of like what happened in the UK last week. And I want to talk with you about that in a bit too, where the Fed just might not have a choice. It may be faced with, a credit seizure, a Lehman type moment where it's just worried about the system actually working tomorrow, right? So I guess first question for you is and I know I'm asking you to pontificate here. So I know we're just talking in probabilities, and hopefully I'll have you back on again as things develop, so you can call audibles for us. But do you feel that the Fed is going to be able to get inflation under control here, or do you think that some sort of systemic risk is going to force its hand before it can?
I think both could happen in the sense that, I mean, the inflation picture is totally unpredictable, and I'm not a forecaster, and I wouldn't dare to forecast what it's gonna look like early next year. But you might get a financial instability episode that comes at the same time as a global slowdown, which does in the end take the edge off of the inflation that
Right,
we've been having, but not in a good way, right? It's
right.
kind of the worst possible way to fight inflation is with a global financial crisis. And anybody hoping for a crisis in order for the Fed to pivot has their, is too young to remember 2008 and has their priorities a little bit mixed up.
Mm-hmm.
And so, but I think to your point, I think the Fed uses these analogies like delicate balancing act, narrow path, and they all work, right? The path is it's ridiculously narrow, right? I thought the analogy I thought about the other day is it's a little bit like, and maybe I thought about it because I was watching so much, uh, hurricane footage, this awful stuff that happened in Fort Myers,
Mm-hmm.
and it's kind of like taking out the levees from a river to let it overflow, but hoping like only the basements are going to flood, but like anything above ground is going to be fine. That's kind of like the closest that I could come to, right? It's a really, the tools are totally crude, and they policy it affects the economy with the lag that they don't know the exact timing of, and so I think it's exceedingly hard for them to get this right.
Okay. All right. That's a great context as well. Again, like I said, coming from somebody like you who watches them so closely. That's a great analogy as well. I'm gonna have to steal that. To me, it sort of sounds like a surgeon describing a delicate procedure he's about to do, except he doesn't have a scalpel, he's got a chainsaw, right? It's just there's only so precise you can be with a chainsaw, right? All right. Well, look, one of the things that is sort of different this time, and I hate using that term because a lot of people use that to justify all sorts of things that can't happen. But prior to comparing it to 2008 or comparing it to the Volcker era, which a lot of people are doing these days, is the debt load, right? So we have total public debt to GDP of 125%, and that's not even taking the entitlement liabilities, like Social Security and Medicare into account, right? Which make that number some crazy number here. So do you have a sense of like at what federal funds rate the system would just sort of almost mathematically have to buckle at?
I have no such sense whatsoever, because I'm not an economist, but I do have the sense that the terminal rate ceiling is a lot lower compared to the Volcker era, just because of that scenario that you just laid out. So there's no, even the most hawkish forecasts for how high the Fed funds rate might go don't match kind of the 1980s gusto, because we're just not expected to be able to get there from a financial perspective, as you suggested. So
right. In putting it another way, the Fed has a lot less wiggle room around rates than it did in previous eras, just because of that. Correct?
exactly.
Yeah, and there are some, and look, I don't know the number either, right? But there are some who think we may have already passed it. It might have been two something or three, and we're now at what, 3.25 or whatever, and then odds seem quite good that 75 basis points are going to be the next hike.
And it's not even just the level, it's the speed, right? Like
Yeah,
75 basis points, you have to keep that in perspective. Like 75 basis point rate hikes are essentially emergency moves. Like when people talk about the potential, we're talking about how, whether or not the Fed can engineer a soft landing, and built into that question is the notion of, will the Fed commit a policy error by raising too quickly, right? But you could argue the policy error was already committed, and the admission to that is the fact that they're moving in 75 basis point
right.
increments, because they want it to be gradualist. They told us that at the beginning of the tightening cycle. They're like, we're going to telegraph everything the way they usually do, but now they don't like to surprise markets. They'll tell you it's 75, but hiking that much in that small a period of time is a pretty radical act in a world of this much debt. So it's not just the level, it's the speed of change. And so
And that's a great point, and I'll see if I can find the chart. I've shown it in one or two videos before, but it shows that the rate of change of rate hikes that the Fed is undergoing is the highest by far in the data set. And just to get back to our analogies, there's sort of two analogies I've used. One is It's sometimes like, throwing a person into an Arctic lake, right? You're changing their body temperature so fast, you send them into hypothermic shock immediately, right? And that's what the speed here can do. The other analogy I use that might even be more apt, I think, is, Pedro, I could give you a gallon of water and give you a week to drink it, and you'd have no problem, right? But if I just shoved that up against your mouth and forced it down your throat all at once, you could drown, right? And that's why the rate of change here is so important. I see you nodding as I'm saying this.
Absolutely, both very good analogies. Slightly scary as well, but yeah, exactly.
Well, and in the circles that you travel in, talking to policymakers, how concerned are they about this? I mean, they've got to know that they're moving with a rapidity that is unprecedented so far.
They're concerned, but they're more concerned. I mean, the policymakers themselves are more concerned about the inflation expectations genie in which they put so much stock getting out of the bottle, and the notion that the more months that you see an 8 to 9% print on CPI, the more likely you are to get some kind of what they think of as a wage price spiral, where people start to ask for wages that are continuously higher and potentially even higher than the rate of inflation. So that's their primary concern. And so even Loretta Mester, who's the president of the Cleveland Fed, there are still a couple of gradualists on the committee, but the majority is now squarely in line with the view that the risk of doing too little is greater than the risk of doing too much.
Too much.
Okay. So their bias is toward breaking something, toward doing a little, toward overdoing it, basically.
Yeah, I mean, clearly, when you hear Powell, he's basically saying, "Look, I'm going to sacrifice the jobs market for sure, and I'm going to sacrifice economic growth to tamp down the flame of inflation here." I mean, he's basically said, I'm going to take that cost. I'm not happy, but I'm willing to make that trade-off here. Here's a question that I've been getting asked a lot recently, and I'm curious to get your input on it, which is, if you look at economic growth, it's slowing dramatically. That said, I just looked at the Atlanta Fed GDP now numbers, and it spiked from like 0.5% up to like 2 something in the last day of the quarter. I haven't fully digested that yet. But we had 2 contracting quarters beforehand. If you look at almost all the other economic data, it is all decelerating, and it all looks like we're heading towards recession. There are many that would argue we're already in it here, and so to a certain extent, a recession will bring inflation down. It'll reduce those inflationary pressures. So there's an argument that says, oh, if the Fed pivots before CPI is back down to 2%, then it's just going to go back off to the races again. And we're going to be stuck in the cycle we were in the 70s, where we were having to tighten and then ease and then tighten and ease because we couldn't get inflation totally under control. But the question I'm hearing is will it really? Because we had, a decade basically of generous monetary policy, and CPI remained relatively contained. We had years, nobody really believed it, but we had years of CPI below 2, and central banks saying that they wanted inflation higher than it was. If we're seeing that, if the Fed just went back to went back to quantitative easing, would that drive liquidity that would actually bring CPI up, or would it just sort of pool, up as excess reserves within the Fed and maybe goose some financial assets? But I guess my question is would CPI really slingshot back up without commensurate fiscal policy, because that's fiscal stimulus, because that's really what seemed to drive the inflation? Because obviously fiscal stimulus, that goes directly into the economy, right? That gets injected directly into the circulatory system of the economy, where monetary stimulus oftentimes kind of pools up, like I said, sort of in the banking system.
Yeah, I think there are 3 main elements that you could, with hindsight, look at as underpinning this inflation. You had the monetary response, which was, arguably longer than it needed to be by some measures. There was the fiscal stimulus in combination with that, and it was a very large sum as well. But then there were the supply side issues, which affected the entire global economy, in which think was the most unexpected part, and potentially the biggest driver of this inflation. So the Fed is just trying to act on the demand side and hoping that the supply side eases, but we actually haven't seen easing on that side either. One of the issues for the Fed is that by the change that it made to its framework, by tying itself to kind of outcome-based policy, I think the Fed risks chasing lagging indicators, and maybe it wants to do that because it really wants to break the back of this inflation. But to your point, inflation might be coming down, and the Fed is still going to, underlying inflation might be coming down, but the Fed is going to keep paying attention to this range of indicators that shows that the number is coming down potentially too slowly for its target. And one of the issues is we were talking about them moving 75 basis points a meeting. They've now basically tied themselves down to that new pace, which is an outlandishly fast pace. And it's a pretty high bar for them to ease off that pace if CPI doesn't cooperate kind of fairly soon.
Right.
And so that puts them in a difficult spot because, if you do a couple more 75s, if after three hikes we're already getting these kinds of bubbling up of financial troubles in the system, I can't imagine what happens, 150 basis points or more later.
Right. Well, and I want to get to that in a minute in terms of like, what do we think a breakage really looks like here? But to this point, like one can maybe raise the argument that inflation may almost kind of take care of itself here, right? That if the Fed has already tightened, one element we haven't talked about yet is that you would know better than probably most, but there's a delay from when the Fed pulls a lever to when you see the impact of that lever happen in the real economy, right? And I've heard all sorts of estimates, but the mean sort of seems to be around 9 months or so, right?
Yeah, well, it depends. Some say actually even as long as 12 to 18 months, depending. Some Fed officials are now making the argument that, look, because we communicate better than they did in the Volcker era and we're transparent and we talk about our policies, our forecast and our SEP gets built into markets more quickly, and therefore the transmission is more rapid. Then maybe there's a case for that. But that just highlights the level of uncertainty, anywhere from like 6 to 18 months, right? So they really don't know.
Right. So they really don't know. So my point is here is let's assume for a minute that the theory I'm mentioning here is right, which is that inflation is going to kind of take care of itself here without fiscal stimulus coming into the system. Economy is slowing and, demand is coming down because of what the Fed has already done, right? and also just, high prices can cure high prices. People just start tightening their belts, right? Especially if we start seeing, layoffs and stuff like that too, that'll bring it down even further, right? We could continue sliding further into a recession or something breaks or whatever. The Fed could say, "Oh, you know what? We tightened too much. We got to pause, or maybe, geez, we really broke something. We got to start stimulating here." But we're going to have these waves of previous 75 basis point rate hikes that haven't yet manifested, right? So they're going to keep slamming into the economies for some period of time after that. That could offset whatever the Fed's trying to do. And to my point, if it's just monetary policy, the Fed might be able to keep certain players alive with its bailout programs and whatnot. But if the money doesn't get out into the real economy, and a lot of it didn't, it might not be able to really fight that. So could we have this process where the Fed pivots, and yet we don't really see any change? We actually can see a continued devolution for some period of time, maybe measured in quarters.
That's a great point, actually. I hadn't thought about it that way, but if the Fed has its way, in their ideal world, their pause, and that's kind of part of what the Jackson Hole hawkish message was all about. It wasn't just about raising people's expectations for rate hikes. It was about pushing back against expectations for rate cuts next year, right? And so the Fed is hopeful that it can raise to the terminal rate, whether it's 4.25, 4.5, and then just keep it there.
And then just hang out there.
Which, if it does that for 2 years, then maybe the long and variable lags have already, been digested and the scenario laid out would not actually be a problem. But if they had to react a little more nimbly or quickly because the economy was really tanking or the financial system was kind of, falling out of bed, then to your point, yeah, I think it would be difficult. And there's another element to that as well. Is, I mean, now rates are fairly high, and if they go all the way to 5, they do have a decent amount of cushion with which to just cut rates.
Right.
But I think they will have a hard time going back to QE as a monetary policy tool. That's my own. I mean, I think they might try in the next deep recession if rates get close to zero. They might have to, but QE has been kind of has lost its favor even among the people who were its most ardent proponents back when it was first launched. And so I think the view about how much QE can do to stimulate the economy, like the general consensus view now is that QE works as a kind of emergency tool when markets are breaking, but not as a stimulus tool, just as a substitute for zero, for rate hikes when rates are at zero. And so even I think that tool is kind of, potentially not as strongly in the toolkit as before. So to your point, the Fed will be more powerless in the next downturn to be able to stimulate things.
All right. Well, that's a super important point, which is what I hear you saying is the era of QE may be ending here, and I'm curious as you react to that. Is there an acknowledgement on behalf of those people that were champions of QE on the policy side that not only does it not stimulate the economy as much as we thought, but it actually really makes the wealth inequality issue worse?
It depends on who you talk to. People have different views. I mean, some people definitely agree with that viewpoint. Others focus more on like the actual the financial stability concerns that arise from the extensive use of QE, right? Which I guess is part and parcel of the inequality, but it's a little bit different. It's about the notion of like reaching for yield to the point that it turns out that pension funds, become illiquid at the drop of a hat. And so,
right. Well, and sorry to interrupt, but to your point, QE, or at least keeping rates at such rock bottom lows through intervention, forces players to go out on the risk curve.
100%. That's kind of the point. They want it to
that's
happen.
The point you're making. Yeah.
But the downside is that it forces them to go out on the risk curve, and that when you try to reverse things, you have even less leeway, irrespective of the debt levels, just because of people's positioning. So
yeah, we're pulling analogies out of every crevice today. There's one I've used a lot and did previous to this year is one of the faults of current central bank policy, or the policy we pursued over the past decade plus, is with holding rates so low and intervening, it has been pushing investors out into thinner and thinner ice as they've had to go chase yield. And because we went a decade without something quote unquote breaking, people have had begun treating the ice with the confidence of concrete, right? Which means, they're wholly unprepared for the moment when the support gets removed, the ice breaks, and they're way out there on the risk curve, and then that's where the real damage happens. I see you nodding as I'm saying this.
Absolutely. That's exactly the point that Tom Honig, the former Kansas City Fed chief and also the former vice chair of the FDIC, makes to me whenever I talk to him about these sorts of things. Is he really emphasizes that the idea that you have a whole generation of traders and trades and financial plans that are predicated on permanent zero rates, and it's hard to to overstate the risks that arise with that.
All right. So when you think of potentially the era of QE as we know it sort of being over, does the end of sort of ZIRP, go along with that? Is the Fed hoping for a new floor, a higher floor here going forward?
I mean, they are and they aren't, in the sense that they would love to have a higher floor, but not because it means permanently higher inflation. They're not trying to,
right.
They're really pushing back. Some people are saying, like, I attended a Brookings conference here in Washington where the idea that the Fed might have to settle for 3% was being discussed, right? Because the notion is that bringing inflation down to 3% would be would cost X amount of pain, but that last percentage point would be just so unbelievably painful in terms of the employment hit that it would take to get that
Right.
last percentage point.
It's the
That you
80-20 rule that the last 20% comes at an 80% pain threshold.
exactly. And so therefore the Fed might actually want to think about not doing that. But Jim Bullard was asked about that this week, and he pushed back hard against it. He thinks it would be, would undermine the credibility of the central bank that has repeatedly said its target is 2% to suddenly settle for a higher target. So I don't think they want to be. I don't think so. To qualify my statement, I think it's the end of QE as a stimulus tool, not as a crisis management tool.
Got
So
it. Got
I
it. Yeah.
think they'll pull it out of the cupboard when it's really like, when stuff's really hitting the fan. But the end of ZERP, probably not so much. They historically have had to cut as much as 500 basis points in recessions, and I don't think they'd hesitate to do that. But only if inflation is, either totally back to target or well on its way.
Okay. So I'm going to put some words in your mouth, qualify them as you will. There are a lot of investors, mostly the ones that were pretty disappointed after Powell's Jackson Hole speech, but have said, yeah, we hear the Fed talking tough, but it's the Fed, it's Jerome Powell. I mean, the Powell pivot guy, right? Like he's not going to have the backbone to see this through when things start getting tight. And hey, when the Fed pivots, that's when I'm jumping back into the markets because everything's going to rise back up again because we associate QE with higher asset prices. It sounds like you would say to that person, not so fast. Like I wouldn't put all your chips on that bet.
Absolutely. I think he's going out of his way to prove to the market that he's not that Jerome Powell, and to that point, there's a reason why he invoked Paul Volcker, in the Jackson Hole speech. It was, I think when I spoke to Danielle DiMartino Booth, who you mentioned, the most important point that she made to me was that the Powell is actively trying to break the back of the Fed put and make
Right.
markets believe that this is the real deal, and that he's going to keep doing it no matter what. So I think that it's not a totally unqualified hawkishness, because I think the potential for financial instability here at home is greater than it was in the Volcker era because of the discussion that we already had about debt levels and leverage and a long period of low interest rates. And so I think the limit for him, though, might be some kind of true disruption in the U.S. financial system that looked like it was 2008 style contagion. It was affecting the banks, or a seizure in the treasury market, which has had liquidity issues recently. So
Right. But let's take either one of those. Let's say either one of those is what forces him to pivot here. That doesn't necessarily mean like that a Fed rescue plan there is going to send asset prices off to the races. I mean, that's a pretty horrible position to be in, right? There's a lot of things, a lot of bad things that are happening at that stage. It's not a super bullish argument for stocks.
Absolutely not.
Yeah. Okay. So I just want to get that out there, to let folks know that Fed pivot doesn't mean happy days are here again.
No, it probably means the worst actually these days is that they've made clear that it's going to take an inordinate amount of pain for them to pivot. And so when we get to that pivot, it's not going to be great. Unless we get a really benign outcome where inflation just starts to come down in the next few reports, and they can slow the hikes into early next year and kind of wait and see. But
well, what's so funny to me is, I mean, I understand the skepticism a bit, Powell pivot and all that stuff from 2018, but those same investors are the ones that crafted their entire investment strategy over the past 12 years on the single phrase, don't fight the Fed. But for some reason right now, they really want to try to fight the Fed, right? It's like, for some reason that they're willing to embrace that when everything's going up, but when it's going down, they're unwilling to still hold true to that. But it sounds like what you're saying here is, hey, don't fight the Fed.
Well, I think it's in part because, and it's also why Powell has to be so strident in his message, is because the recent Fed has a strong record of intervention, right? And so there's again a generation of traders that's conditioned to think that like if you just you just raise the pain threshold a little bit, the Fed's gonna flinch. And so they've repeatedly had to push back against that notion in this cycle.
Okay, so let me ask you this then, Pedro. I'm just curious, given your somewhat unique position as a guy who just lives in this world 24/7. How culpable do you see the Fed here for where we are? So much of what we've talked about the current state is because of policy that the Fed has made, policy decisions the Fed have made, or ways in which it has trained investors. It had plenty of opportunities over the past 12 years to try to disabuse investors of the fact that the Fed will play Santa Claus at the drop of a hat, but it didn't.
I think that's true, but I think that the inflation itself, it's probably easier to find fault with the Fed's, with the Fed put itself, with that notion of continuous intervention for increasingly weaker reasons, than it is to actually fault them for the inflation surge itself, because I think the inflation that we're experiencing is just so. First of all, it's global, and so it's hard to just point the finger at a single central bank. They're all in the same basket, even the ones that are actually already in recession, like the UK.
Yeah.
And so,
sorry to interrupt, but just to add in, they were all kind of playing from the same playbook, though.
They
right?
were, yeah. And I think, but the thing is, they were. The transitory word was probably a bad choice, but there was reason to believe, especially if you remember the macro situation early on, right? The fear was like a deflationary spiral, 14% unemployment. It's kind of hard to go from that mindset to like, oh no, this inflation is totally for real, having lived through 30 years of fighting the other demons, if you will.
Right.
And so, but I think your broader point about the long-term effects of continuous, ongoing, and increasingly large interventions on investor behavior, are probably a fair critique.
Okay. I also want to sort of talk about their process for dealing with players that get in trouble. Sort of the penchant for bailing out versus other types of solutions. Before I do, though, let's just talk about the Bank of England for a few minutes, because that is a really important recent development here, and that is a really good example of something systemic beginning to break, right? And I won't go into all the details because I've summarized them in a couple of recent videos, but basically, the bond, or what's called the gilt market in the UK, started blowing out, and it threatened to bring down the entire UK pension system pretty much, as well as a bunch of other knock-on effects. And the Bank of England, which was just about to embark, I think days away from embarking on quantitative tightening, had to abandon those plans and step in and at least put in 65 billion pounds worth or buy 65 billion worth of pounds of gilts in the open market, just to sort of stop the hemorrhaging. And the dust is still settling from this, so we'll see. But what's interesting about that, Pedro, is when it's an example that, okay, parts of the world are getting close to their breaking point, and obviously raises the question, can that happen here, and how close are we to ours? But also it raises the question, can the Bank of England continue its inflation fighting crusade now, or has it now hit its limit, right? Where it said, look, we tried, we raised rates for a long time, we were about to do QT, but now we just got to worry about our bond market functioning, and that takes priority. And sorry, guys, we're going to live with longer inflation from now on.
Well, they're between a rock and a hard place in that sense, because they need the rate hikes to be able to stabilize the pound, right?
Yeah.
So they can't give up. That's why they kind of opted for foregoing QT for now. But there's still all kinds of questions about how functional the market will be once because remember, they didn't just forego their QT. They kind of re-embarked in a mini QE that they didn't want to be called QE, where they actively opened a facility to buy. They have a gilt purchase program, but it's a short-term one. But they're the other interesting part of it that you didn't mention is that this is happening not in the sort of darkest corners of the financial markets, but it's happening at something that's supposed to be very boring and, and buttoned up, like a pension fund. That's when risks really become troublesome, when they hit the heart of the economy like that, right?
Right.
So,
Well, sorry to interrupt. I want you to keep going, but the pension funds there had you know bought collateral on margin, right? They had levered up, and they had levered up because of what we talked about earlier, right? Is that they had to, because rates had been so low for so long, they couldn't get the yield they needed, so they had to lever up their collateral to get the return they needed to hit their actuarial goals. And then, of course, it blew up.
that's right.
So okay, so I guess my question is it sounds like you're saying we don't know, we're going to have to watch here, but I mean,
Oh, I'm sorry. As far as how close we are to something like that, I mean, we really have no idea, right? They had a very specific, you could say, a kind of forced policy error where they rolled out this budget with very little, without approval of the usual authorities that oversee the budgetary process there, and without preparing markets for them. So that's kind of the case for arguing that this is kind of sector and country specific. But coming on the back of all the tightening that we've just discussed, I think it could well be a canary in the coal mine for other types of risks that we don't know are out there. And anybody who tells you they know where these risks are hiding, is probably lying, because if they did, they would keep it to themselves and go make money off it, probably.
right, yeah, exactly. And also the system's just so, it's so complex that when one domino falls in one place, you just don't know, all the other ones that may fall. That's why the fear is a cascading contagion, right? And that's exactly
Right.
what started happening in the UK.
And then I woke up this morning to Credit Suisse trending on Twitter, and I wondered what's this about, right? So that's another little element of contain. That's when you start to worry, is when you start to see random names pop up that seem unrelated. But I also found it was interesting that, like, there was the report, the CNBC article uh, on Credit Suisse cited a Citigroup report saying there was no reason for worry about contagion. So I thought it was ironic, given the role of Citi in the last crisis. So.
In the global financial crisis. Yeah, no, exactly. Yeah, there's a whiff of sort of, subprime is contained, about that statement. Yeah, and who knows? But that's the issue here. I mean, I'm sure, as Stephanie Pomboy likes to say, it's probably not going to be that long before we start seeing some bodies float to the surface where, these were just the guys that were overexposed on some trade that just blew out because nobody expected, British gilts to go from, low single digits on their way to 7% in the span of 2 weeks or so, right? All right, so but I guess two last questions on this, or two last things about this. One is, what I think is notable about this is it seems that kind of the trigger for this meltdown was also policy related, but it was on the fiscal policy side, where the newly elected Prime Minister Liz Truss had basically said, all right, we're gonna put forth a big tax cut right now because people are so, they're getting so punished by inflation. We got to bring some relief to them. And there was no clarity on how it was going to be funded, basically, except to just assume that the government was going to borrow to do that. So it's kind of, it was at odds with monetary policy, right? Monetary policy was in the process of stepping on the brakes, and here you have fiscal policy saying, no, we're going to step on the gas, right? And the markets just got jittery about that, and then this whole thing, started to go. So it does show that, policy isn't in a vacuum, right? The central bank doesn't have all the ability to influence what goes on, because the politicians themselves can come in and either help or muck things up depending upon what they decide to do. So I guess that's question number one. I'd love if, well, let's start there. So do you have any context to add around that?
I mean, I think it was really the speed with which they rolled out this plan without kind of preparing markets for it, right? And so, but it is interesting that, as you said, the authorities were working at odds with one another, because and that's out of the control of the monetary policymaker, right? And really out of the control of even voters, interestingly, and because that wasn't a sort of it wasn't a normal election. It was a question of like, you know, Boris Johnson having resigned, and so it was a parliamentary kind of move. And the thing you didn't mention also is that they try to impose an energy price cap, right? And
You're right.
that's another factor. And so that's something that in the context of the energy crisis, I think raises concerns about how high, like once you have one in place, it seems like a cash cow that is going to be continuously exploited, and you don't know how high it's going to have to go, which added another element of uncertainty to the fiscal picture in the near term. And so, yeah, it's not, I don't think anybody had UK pension funds and fiscal crisis in their, Fed
I,
pivot bingo card, but
I
here
was
we
going to say
are.
on their bingo card. Yeah, exactly. What do you see the potential risk for something like that happening here in the States? So let's go back to what you said earlier, which is you think that Powell is really he's chained to the wheel, he's lashed to the wheel here. I'm gonna stick with this course until we get inflation under control. Um, and you know, that could end up in a deep recession. And let's assume that inflation is taking longer to resolve than everybody wants, where you could still have high cost of living, but people are now losing their jobs, whatever. And Congress might feel compelled to move to say, well, we got to do something to help the average person here, and could potentially decide to do fiscal stimulus when Powell is trying to say, no, I don't want to do QE and have monetary stimulus. We're trying to starve the system of oxygen here. And then Congress goes and tries to do another, 2020 style bailout package, or not bailout package, but stimulus package.
It's a possibility, but maybe our political dysfunction works in our favor in this case because it doesn't seem like the political winds are blowing in that direction. So I
Because you
think
think, well, the Democrats will probably lose control of Congress and we'll just have more gridlock.
I think that's right. And even if they don't, the likelihood of them passing something, in the second half of the first term is sort of significantly weakened, I think. So I think the chances of something like that are lower, but that doesn't mean that we won't have financial instability here, right? So it doesn't have to come from the fiscal side. We could have disruptions that are just related to, we haven't even talked about housing, but you
Yeah.
know, the housing sector is already crashing pretty hard, and it could be poised for even worse performance next year. So we don't know what kind of financial stability implications that would have. So
Yeah, so I'm curious. Do you have any? So I've talked about it relatively recently with housing analyst Nick Jurley, and actually spent most of my weekend on Twitter talking about the state of the housing market, because I have a hard time just mathematically not seeing it go down pretty substantially from here. Just there's many factors for that, but just one is the fact that mortgage rates have more than doubled in the past 14 months. Um, so the issue with housing is that it is much more widely owned than stocks are, right? Something like 90% of all financial assets are owned by the top 10% of households, right? But two-thirds of households own their home, right? And so I believe the negative wealth effect of a housing correction has a much bigger impact on consumer spending as a result. So I agree. But is there anything in particular that you want to say about your concerns about the housing market?
that's exactly right. It's just the size and scope of the housing market, and also its linkages to the financial system are just so great. The size of the market in terms of trillions of dollars is so large that it just has systemic implications. And people are talking about, well, banks being better capitalized this time and underwriting standards having been stronger this time. But I think you pointed out on your feed, price appreciation was just outlandish over the past year, right? It was just, stratospheric. And so the potential for significant losses is there. And I think people are quite unprepared for it. So that would make it worse because it would come as a surprise.
Right. And then, as gave a little bit of nod to this earlier, but as we continue to see compressed corporate margins from both high input costs with the inflation, but also higher cost of capital as the Fed's out there raising rates, right? If we go further into recession, if consumer spending constricts because of a negative wealth effect, either from their house going down, their stock investments going down, or just concern for their jobs, if that spending constricts, then corporations have to start laying people off, right? And then of course, you almost get into a vicious cycle from there. So I mean, there's just so many shoes that could could drop here that could continue to take the concerns you're just mentioning here and multiply them. So anyways, all right. So let's assume that we get to some sort of systemic breakage point. The question I'm trying to get to is in a recent conversation with Lacy, I talked with Lacy not that long ago, and Danielle DiMartino Booth also talked with him. And I didn't talk with Lacy about this. I wish I had, but she did, where he said, hey, he echoed your thoughts that the Fed may actually stop doing QE as a stimulative strategy going forward. And when Danielle asked him, okay, well, what happens if financial stability arises? And he said, well, we actually have tools. There are existing tools for dealing with that are different than just bailing companies out, which is what the Fed has been preferred to do of late. But he mentioned the discount window, which I'll admit I'm not a total expert at, but my understanding of it is it's sort of a process for helping systemically important companies that get into trouble. And instead of just letting them go belly up overnight, and then everybody who has counterparty risk is dealing with the shockwaves from that, the Fed basically partners up with them and says, you know what, we're going to help this company. And yeah, it may actually be going out of business here, but we're going to make that a slow and gradual process. We're going to work with all the lenders. It's going to be orderly. And you kind of let these companies fail if they must, but it's a managed failure that doesn't create the massive shockwaves through the system. Do you see us perhaps using tools more like the Fed choosing to use tools more like that going forward if we encounter these breakages?
I think what the Fed would opt to do is to have targeted lending facilities like the one that they're very creative about,
like TARP and TALF and all that stuff.
Exactly. Well, and like whether it's a commercial paper funding facility, wherever the breakage is, money market funding facility, the discount window is a little bit different because the discount window is more for like if there's a systemic run on banks, it's a place where banks can get unlimited funds, but there's all kinds of issues about reputation, and once your name is associated with the discount window, there might be a self-fulfilling run, and so they've had to create workarounds to make the discount window more palatable to borrowers. But that's if we're talking about that, then we've really gone down the 2008 route. I think what would be more likely is something aimed directly at the treasury market, for instance, just to enhance liquidity over a short period, or something aimed at money market funds if they were the ones where the troubles were. That would be their attempt at. And then I think they would actually be able to, or at least try to keep tightening monetary policy at the same time. And that would be a difficult thing to do, as the Bank of England has discovered. It's difficult to, push and pull in different directions at the same time. But it is something that the Fed has indicated it would try to do if there were trouble in financial markets. It would try to tighten through that period by just making liquidity or funds available to specific sectors as needed.
Okay, so what you're saying is they would continue to try to reduce the balance sheet. They wouldn't be buying assets the way they were in QE, and they wouldn't be "quote unquote" bailing out these companies with long-term purchases of their distressed assets. You're just saying they would give them access to sort of like short-term credit facilities to kind of keep them going until they fix whatever.
I think that's right. Although there is a precedent for buying corporate bonds, which they did in during the post-pandemic kind of reaction. So there is a precedent, and there is a facility that they could revive if it were. But then again, it would have to be a corporate credit crisis for that to become a relevant issue. So it really depends on where the trouble arises, if you will.
Okay. All right. Well, look, you've been wonderful at answering all the questions in your area of expertise. I'm going to ask you one that might be a little outside of it. And it's understood here that you're just giving your kind of best guesses here, and this isn't specific financial advice for any individual. But given your current outlook for policy, what you think is the most probable course from here, obviously policy has impact on financial assets, and certainly currencies as well, purchasing power for currencies. Are there any asset classes right now that you think are, particularly wise to consider given where you see Fed policy going, or even the other side of that, ones you would definitely not touch right now, given where things are going?
I wouldn't touch that question, to be honest. It's not the kind of thing I ever answer or even think about. I mean, I think that just broadly speaking, I think that the risk off mood of the markets is not that we're not done with that. So you can interpret from that whatever asset class you'd like, but I wouldn't get much more specific than that.
Okay. And so, yeah, let me add to that a little bit more, which is from everything you've told me, it sounds like if the bullish case in the markets right now rests on Jerome Powell changing policy, you would say, it's not something you expect him to do anytime soon.
Yeah, that's a weak case on two counts that we've discussed, right? The first is I don't expect him to do it. Two, if he does it, it's for a terrible reason that is not particularly bullish. At least not in the short term, not until it has enough of a fallout for the authorities to react and to actually put a floor under the market like they did in March of 2009. And then there's a lot of denouement after the pivot, if the pivot is happening for financial instability reasons. So
okay, all right. So let me pivot then and ask a question about currencies, right? Which there's a direct link between the increase in currency supply that a central bank does and the purchasing power of that currency. And interestingly, the dollar has really strengthened this year, right? For a whole host of reasons. And I've talked about this a lot with a lot of experts, but most notably Brett Johnson, who has the dollar milkshake theory, which really does seem to have been playing out according to plan this year. But there's a lot of people out there who, don't like the dollar and say, the Fed is it's just a printing monster and it's going to destroy the purchasing power of the dollar over time. Listening to you, it sounds like you are expecting a more conservative monetary policy going forward than what we've had in the past. And so in some ways, it would contradict the dollar bears argument. And obviously dollar strength is totally relative to what other central banks are doing with their currencies. But those guys are going to be even worse. Generally, most of those countries are going to be even worse shape than us. So I guess it's a long-winded way of saying, do you expect the dollar strength to remain strong for a good while from here, given your approach?
I do because of, as you say, it's a relative game. So I don't look at it as like, oh, this central bank is being particularly aggressive, so it is going to erode the purchasing power of the dollar, because the dollar is special in so many ways, and it has that sort of golden reserve currency status that affords it, these benefits. And I don't see that. People thought of the Chinese yuan as the main potential alternative, and the COVID zero policy has put them further and further away from kind of economic global dominance, and so that just puts the dollar back in the driver's seat. And so I don't expect, there's going to be a lot of volatility and fluctuations, but I don't expect sort of dollar hegemony to be eroded anytime soon.
Okay. Two last questions and we'll wrap this up. I would be remiss, I think, for some of the audience not asking you this question, which is the whole topic of CBDCs, and we don't need to get into it totally here. But I guess my question for you is do you see the Federal Reserve issuing, or do you see the U.S. issuing a CBDC, within the next couple of years?
I don't. I think that whenever you hear the Fed officials talk about it, they talk about it as something very preliminary and theoretical, and they're always kind of working on the background discussions of it. But I don't think it has any. But there's a lot of skepticism as well. Like Neil Kashkari has said, I don't understand the problem it's trying to solve, and there's a lot of. I think it's very early stages for anything material to emerge. And I'm not sure that it ever will emerge.
All right. Well, I got to ask then. Okay, why that? Why that skepticism?
Again, because you don't get the sense that it's a top priority for them, or that they see. I mean, I think Kashkari is the one who says it openly, but I think it might be a more widely held view that like they don't quite understand what problem it's trying to solve and what niche it's trying to fill.
Okay. And that's interesting, just because Kashkari is one of the younger members. I mean, you would think that if somebody kind of got, the digital currency story, it would be the younger guy. By the way, I'm no proponent of it at all, but I've always sort of thought about it as sort of a central banker's, fantasy, right? You have this currency that's immensely controllable. You can be very surgical with it. You can do all sorts of things if you want to stimulate the economy, like, hey, we're going to give out money, but it expires in a certain period of time, so you're forcing velocity into the system. Even just the benefit of there's so much of the economy right now that is dark to the authorities, right? Just the cash economy, right? Sure. All of a sudden, now you know where every dollar is, what it's being spent on, how to tax it. It just seems, again, like a central planner's, forgive my language here, but wet dream. So I'm just a little surprised that it seems like the interest is lukewarm at best from how you're describing it.
I also get the sense that the major banks don't have any particular, don't really like it, and that would probably carry a lot of sway in terms of like how the banking community influences Fed thinking. So.
Okay. Well, again, this is an ocean that you swim in every day and have for the past 20 years. So what you say carries an awful lot of weight. There's a lot of people in the media, online, who spout opinions about, all sorts of things that we're talking about here. But just on this topic alone, you are talking to the most informed people about this topic, because you're talking to the people that actually set policy here. So I really do value your perspective here. All right. Well, look, Pedro, it has been fascinating getting to crawl inside your brain as the man who talks to policymakers all day long. Super valuable, great insights. I really do hope you'll be willing to come back on again in the future and call audibles for us as we're further along in the story here, especially if things really start to break more visibly here in the U.S. For folks that have enjoyed getting to know you through this conversation and would like to follow you in your work, where can they go?
Absolutely. They can go to marketnews.com to check out our Fed coverage, and they can follow me on Twitter at PDACOSTA, P de Costa.
Okay, great. And when we edit this, we'll put up the URL and your Twitter handle there on the screen, so folks know exactly where to go.
Awesome. If I could also put in a plug for my own podcast.
Absolutely.
It's called Fed Speak, and I interview senior policymakers at the Fed, a few former policymakers, senior staff economists. It's a weekly show, and I really try to get down to kind of, the latest and greatest twist in Fed policy. So, check in and subscribe.
All right. So for you complete policy wonks, definitely go listen to Pedro's podcast there. All right, folks. Well, look, as we wrap up here, very quickly, I just want to remind folks that we are continuing our practice of me writing up my key takeaways from these interviews. So if you want to get mine from this interview with Pedro, just go as usual to wealthion.com/Adams Notes. Obviously, a massive question to what Pedro and I have talked about is, how do you actually invest for this kind of environment where we may be dealing with systemic breakages at some point in time due to policy decisions the Fed is making right now. If you want to talk to a financial advisor who keeps those type of issues in mind in creating their portfolio strategy, Feel free to talk to one of the ones that Wealthion endorses. Just go to wealthion.com. You'll have a free consultation with them. Doesn't cost you anything, no commitment to work with them. And if you have enjoyed having Pedro on this channel, would like to see him back and like to see other great guests of his caliber on this channel, please help support us by hitting the like button as well as the red subscribe button below. Pedro, thanks so much. Really look forward to having you back on this channel again. Everybody else, thanks so much for watching.